Central banks continue to battle inflation by raising interest rates, and this has been terrible news for growth stocks, which have suffered considerable falls as a result, but also for borrowers, for mortgages, say. But for people looking to park their cash safely, this is great news, because now you can generate more income for fairly low risk. So in this video, we'll look at how to do that efficiently, but as usual, we'll look at the risks that go with that. If you do enjoy our content, please do subscribe to our channel. That way you won't miss any new content. So let's look at where to hold cash in a bit more detail. Let's begin by looking at those policy rates. Here are some of those central bank policy rates for the US, Canada, the UK, Australia, the Eurozone, but also for Japan. And with the exception of Japan, you can see that there's been an aggressive increase in rates. Although if we put it in context, you can see we're just going back to where we were before the global financial crisis. In fact, rates then were a little bit higher. But if we zoom in on the period since 2020, you can see how rapid and synchronized those increases have been. Now, if you're a borrower, say for a 2-year fixed mortgage in the UK, that's been a huge problem because interest rates have increased in line with the Bank of England's bank rate. So whereas previously you could borrow for as little as 3%, even for a 95% loan-to-value mortgage, now that rate has surged, although it has fallen a little bit since its peak at the end of last year. So for borrowers, this surge in policy rate has been really bad news. Now normally you get paid to take more risk, but what's really odd at the moment is in the fixed income space at least, you're paid not to take risk. What do I mean by that? Well, if you look at the US 1-year rate and the 10-year rate going back to 1960, you can see that what usually happens is that the 10-year rate is considerably higher than the 1-year rate. That's because if you lock in a fixed rate of interest for longer, you're going to have a more volatile investment because as yields fluctuate, you gain or lose more. So there's a kind of multiplication effect of duration. But sometimes what happens is that the yield curve inverts. In other words, the short-term interest rates are greater than the long-term interest rates. So it's cheaper for the government to borrow long-term than it is short-term. And what people focused on recently is that that's seen as a sign that we're about to get a recession. So that's what these shaded blocks are, US recessions. And you can see that if we plot the difference between the 10-year and the 1-year rate, when that goes red, when the curve inverts, usually you get a recession in the US within about 6 months to a year. But another consequence of an inverted yield curve, and here I've shown the US and the UK yield curve right now, is that you're being paid more to take less risk at the moment. So if we look at the 6-month rate right now in the UK, it's over 4.4%. And if we look at the US, it's over 5%. Whereas if we compare that to lending to the government for 30 years, it's generating a lower income, a lower yield. So although this is a bit topsy-turvy and bad news in some ways, because it could lead to a recession, in other ways it's good for people who want to park their cash temporarily while taking very low risk. And just to illustrate that risk, here I've shown you that 1-year and 30-year rate in the top panel. This is for US Treasuries again. But in the bottom panel, I've shown 2 funds. One of them invests in short-term US Treasuries. These are 1 to 3 years in maturity. And the other one, TLT, invests in 20-year plus US Treasuries, very long duration. Notice how the long duration fund TLT, which is the red one, fluctuates hugely in price. It's very volatile. It's exquisitely sensitive to movements in the 30-year US yield. Whereas if you look at SHY, it's almost completely indifferent to moves in the yield curve. There are fluctuations, but they're much smaller, and this is much more cash-like. Another attribute of SHY is that it picks up increases in the interest rates much faster. That's because it turns over the bonds on a much faster schedule. If the bonds only have 1 to 3 year maturities, they can only exist in the fund for that period of time, and then they have to be replaced by newly issued bonds with higher coupons. So how can we earn this short-term yield? In fact, there are many ways to earn it. Probably the simplest is just to buy short-term government bonds. In the US, you can do that via Treasury Direct, a brilliant website. In the UK, you can do it with some UK brokers. But what's great about that approach is that you know exactly what maturity you're going to get. If you buy a 6-month bond, you know that you'll earn the 6-month yield. If you can't buy single bonds or you don't want to buy single bonds, another option is to buy a bond fund. All I'd say here is to make sure that it's a short-term government bond fund. Also, that it's in your currency. That's really important, as we'll see in a moment. A third option is to buy a money market fund. So these are ultra short maturity funds. They only buy instruments which are almost like cash, and their volatility tends to be very, very low. The kind of instruments that they buy would be things like certificates of deposit. So these are deposits with a bank, or maybe government bonds with 6 months or less to maturity, or maybe something like reverse repos with the central bank. If you're based in the US, you can go for a certificate of deposit. So this is a fixed term deposit with a bank, and the longer you lock it in, usually the more interest you're going to get. And the UK equivalent of that would be something like a fixed term savings account. We don't call them certificates of deposit, but it's pretty much the same thing. You're lending to the bank for a fixed period of time, and both for certificates of deposit and for fixed term savings account in the UK, if you take your money out early, you'll pay some kind of penalty. Now, my podcast co-host, Michael Pugh, and I have done a whole episode about where to park your cash. So if you want to listen to that, just go to your favorite podcast provider. Let's begin by looking at some UK money market funds, although the lessons here apply to investors everywhere. So here I've shown 8 UK money market funds or money market-like funds, and there's actually one wild card in the pack, as we'll see in a moment. On the face of it, they just seem to have sterling exposure. They're denominated in sterling. Some of them are income funds, some accumulation. For the accumulation funds, the income is continually reinvested and appears as an increasing price. For the income funds, they'll pay you cash on a regular basis into your brokerage account. And if we look at the expense ratios, they tend to be very low. The most expensive of all is this PIMCO fund, this sterling short maturity source ETF, and that's actively managed, which explains why it's expensive. But on the whole, the expense ratios tend to be 0.15% or significantly less. Now, if we look at the volatility of those funds, that's the typical annual percentage price move, there's one that really stands out, and that's FedG, the Lixor Fed Funds US dollar cash ETF. The reason why the volatility of that is over 10%, whereas all the others are less than 2%, is that you're seeing the currency fluctuations. For a developed market currency pair, that's usually around 10% per year. So really with this fund, what you're investing in is the strength of sterling versus the dollar. If the dollar strengthens, this fund will gain in value. If the dollar weakens versus sterling, then it'll lose value. So all I'd say is be absolutely sure that whatever you buy doesn't have that currency risk. Otherwise, it's going to massively increase the volatility. That's really important when you're buying something cash-like where you've deliberately gone for safety. So if we take out that wild card, we're left with 7 UK money market-like funds. So these fall into 3 groups, and this applies universally wherever you're buying your funds. The first group is smooth. So if you look at the price of this fund, it's CSH2, which is the Lixor Smart Cash Fund, and its gradient represents the rate of income because it's an accumulation fund. So when rates are low, it's almost flat. Notice that it also doesn't fall, just like cash. If you've got cash in a bank account, you wouldn't expect its value to ever decrease. It only ever increases with interest. So you can see the rate of growth of the fund has increased recently, and that's because short-term interest rates have increased. As we'll see, that's because of the index which it tracks, which is called SONIA. If it's a little bit wiggly, like JGSA, so that's the JP Morgan Sterling Ultra Short Income Fund, the reason why it's wiggly is that that volatility comes from movements of the yield curve. As the yield curve moves up, the price will move down, and as the yield curve moves down, the price will move up. So with this fund, it is possible to lose money. Not a lot, because it's got very short duration, but it is possible. And then finally, you can see this kind of sawtooth shape for some of the funds, and that's because they're income funds. Every time the fund goes ex-div, you're no longer entitled to the next payment. So the price will fall by roughly the size of that payment. So that's what you can see with the sawtooth as each of the funds goes ex-div, and then it kind of ramps up to the next dividend payment. So just by looking at the prices of these funds, you can learn a lot about them. Is it invested in the actual yield curve, like JGSA? Is it invested in a cash rate like Sonia? And is it accumulation, which is smooth, or is it an income fund, which is sawtoothed? So the one which I hold in my fund portfolio right now, that's not a recommendation by the way, is CSH2. And if we plot that versus the Bank of England's Sonia rate, that's the Sterling Overnight Index Average Rate, which is the rate at which banks lend to one another, you can see it tracks it fairly well. In fact, it's beaten it for a lot of its history. Over the last year or so, it's actually underperformed Sonia, but it does tend to track it fairly well over time. So just make sure what benchmark you're tracking and what's actually in the fund, and make sure you're absolutely happy with that and you understand it. Now let's turn to US money market funds. And there are many of these. I've just shown 4 of them beneath me, and I've shown their expense ratios, so that's this column. I've also shown the minimum investment. So for example, the Vanguard Federal Money Market Fund, that has an expense ratio which is lowest, 0.11%, but the drawback is that the minimum investment is $3,000, whereas the Fidelity Money Market Fund, SPRXX, has no minimum investment, but the expense ratio there is higher. Now again, it's really important to look at the composition of each of these different funds because the prices and the returns will vary significantly according to how much cash it's got, how much reverse repo, and so on. So again, make sure you understand what's in the fund and that you're happy with that because it affects the risk as well as the return. Now, high return and low risk is usually a red flag. So what's the catch? Well, the risk here is related to the benefits, which is that short-term money market funds pick up increases in interest rates very quickly because of the short-dated nature of their instruments. But the opposite's also true. When interest rates are falling, they'll pick up the lower rate. So let's say, for example, that inflation falls. What will happen is that central banks will cut rates, and that means those short-term rates, which now look quite attractive, will fall. And the money market funds will pick up that fall very quickly. What's the alternative? Well, you can always buy a bond. So you can buy, say, a 1-year, 5-year, 10-year bond and lock in that rate when rates are generally falling. And this is what fixed income fund managers do all the time. If they think interest rates are falling, they'll lock in rates for longer. They'll increase the duration of their funds. And personally, the way I'd prefer to do that would be by buying single bonds. And that way you can lock in a fixed rate of interest, which is absolutely known just before you buy the bond. If you can't buy a single bond, then you could just go for an intermediate duration bond fund, say in the 7 to 10 year duration range. And if you're feeling particularly brave, maybe even more duration. But remember that that comes with extra volatility, and not everybody's going to be comfortable with that, particularly if rates actually rise again and you have a loss. Now, if you are investing for a long period of time, say 10 years or more, then stocks are a much better place to be. They'll almost always outperform cash. So you don't want that cash drag in your portfolio. But for periods of 5 years or less, why not monetize this yield curve inversion and earn that short-term interest rate? Now, if you do enjoy our content and you want to learn more about investing, why not join our community? It's very friendly. You get access to Slack to ask a question whenever you want, a huge library of members-only video content, plus we get our trackers, which our members enjoy using to monitor macroeconomics, but also what's going on in markets. To learn more about that, just click on the link in the description beneath me. And, as always, thank you for listening.